5 stories moved almost every market this week. If you only saw the headlines, you probably missed what actually mattered. Aloha, navigators. This week had a little bit of everything. The Federal Reserve made a big decision about interest rates. Some of the biggest technology companies in the world reported their earnings. The economy gave us new clues about where it's heading. Oil prices reacted to changing events in the Middle East. And a Bitcoin security story reminded us that even good technology isn't perfect. If some of those words sound confusing, don't worry. That's exactly why we're here. Today, the Market Hui is going to break down the week's biggest stories, explain what those financial terms actually mean, and show you why they matter to everyday people. By the end of this episode, you'll understand not only what happened, but why it mattered. Let's get started. Pulse. What was everyone talking about this week?
Thanks, Brada Bitcoin. This week, 5 stories dominated the financial conversation. Let's start with the biggest one. The Federal Reserve decided to leave interest rates unchanged. The Federal Reserve, often called the Fed, is America's second central bank. One of its biggest jobs is helping keep prices stable while supporting a healthy economy. Interest rates are simply the cost of borrowing money. When interest rates go up, borrowing money for homes, cars, and businesses usually becomes more expensive. When interest rates stay the same, investors listen closely to what the Fed says because those comments can give clues about what might happen in the future. The second big story was earnings season. Companies like Microsoft, Meta, Amazon, and Apple all released earnings reports. Think of an earnings report like a company's report card. It tells investors how much money the company made, how much it spent, and how the business is performing. This quarter, investors wanted to know one thing. Is all the money being spent on AI starting to produce real results? Some companies impressed investors. Others gave more cautious outlooks. The third big story was new information about the economy. The government released new reports showing the economy is still growing, although not as quickly as before. The fourth story involved oil prices. Oil prices continued moving as negotiations and developments in the Middle East changed throughout the week. Oil affects much more than gasoline. It also affects transportation, shipping, manufacturing, and many of the products we buy every day. And finally, progress on a cryptocurrency bill called the Clarity Act slowed in Washington. If passed in the future, the bill could create clearer rules for the cryptocurrency industry in the United States. Those were the headlines. But headlines only tell us what happened. To understand what the markets actually did, let's head over to data.
Thanks, Pulse. So, how did the markets react to all of that news? Let's start with stocks. Even though investors had a lot to think about this week, the stock market finished higher overall. The S&P 500 gained about 1%. The Nasdaq gained even more. The S&P 500 is a group of about 500 of America's largest companies. Investors use it like a scoreboard to see how the overall stock market is performing. The Nasdaq also tracks many large companies, but it has more technology businesses, so it often reacts more to news about artificial intelligence. But here's something important. The market didn't move straight up all week. Prices went down after the Federal Reserve meeting. Then they climbed again after several technology companies reported strong earnings. When prices move up and down more than usual, that's called volatility. Volatility simply means bigger price swings over a short period of time. Bitcoin also experienced volatility this week. Some people think Bitcoin only reacts to crypto news. But that's not always true. Bitcoin can also react to the same economic news that affects stocks. Things like interest rates, inflation, and how confident investors feel about the economy. Another important move happened in the bond market. Bonds are investments that allow governments or companies to borrow money from investors. One type of bond received a lot of attention this week. They're called U.S. Treasury bonds. Treasury bonds are loans made to the United States government. When people buy them, they're lending money to the government for a period of time. That leads us to another financial term you'll hear in the news all the time: Treasury yields. Atlas, can you explain what Treasury yields are and why everyone was paying attention to them this week?
Absolutely. Let's start with Treasury yields. When the United States government borrows money, it pays investors interest. That interest is called a Treasury yield. Think of it this way. Imagine your friend asks to borrow $100. If they promise to pay you back $105 next year, you earned $5 for lending your money. Treasury yields work the same way, except people are lending money to the U.S. government instead of a friend. This week, Treasury yields moved higher. Why does that matter? Because Treasury yields influence borrowing costs across the entire economy. When Treasury yields rise, mortgage rates can stay higher. Business loans can become more expensive. Even the monthly payment on a new car can be affected. That's why investors pay so much attention to them. The government also released a report called GDP. GDP stands for Gross Domestic Product. Think of GDP as America's economic report card. It measures the total value of all the goods and services produced across the country. This week's report showed the economy is still growing. That's encouraging, but it also showed that inflation hasn't completely disappeared. Inflation means prices continue rising over time. If inflation stays too high for too long, everyday things like groceries, rent, and eating out can become more expensive. The Federal Reserve is trying to find a balance. It wants the economy to keep growing, but it also wants inflation to slow down. That's why investors paid such close attention to everything the Federal Reserve said this week. Oil prices added another piece to the puzzle. Oil moved throughout the week as negotiations and developments in the Middle East continued changing. Oil isn't just used to make gasoline. It also helps move products around the world. When oil prices rise, transportation and shipping become more expensive. Businesses sometimes pass those extra costs on to consumers. That can eventually push prices higher across the economy. So, while each headline may seem unrelated, they're actually connected. That's why markets reacted so strongly this week. But numbers only tell part of the story. Echo, what was going through investors' minds as all of this was happening?
Thanks, Atlas. Numbers help explain what happened. Now let's talk about how investors felt. This week, emotions changed almost every day. Strong earnings from companies like Microsoft and Amazon gave investors confidence. Those reports suggested that some of the huge investments being made in artificial intelligence are beginning to produce real business growth. But higher Treasury yields, inflation, and uncertainty around the world reminded investors that risks still exist. This is called market sentiment. Market sentiment simply means the overall mood of investors. Think about the weather before a beach day. If the forecast calls for sunshine, you're probably excited to go. If the forecast suddenly changes to heavy rain, you might decide to stay home. The beach didn't change. Your feelings about going did. Investors work the same way. Their decisions are influenced by how they feel about what might happen next. When confidence grows, more people are willing to invest. When uncertainty grows, many investors become more careful. That's why prices can change so quickly, even when nothing has changed about the companies themselves. Sometimes the biggest risk isn't the story everyone is talking about. It's the story almost nobody notices. Ledger, what flew under the radar this week?
Thanks, Echo. One story many people may have missed involves certain older versions of cold card wallet firmware. Before we talk about the security issue, let's explain a few important terms. A hardware wallet is a small physical device that helps protect the private keys controlling your cryptocurrency. A recovery phrase is a list of secret words that allows you to recover your wallet if the device is ever lost or damaged. When a hardware wallet creates that recovery phrase, the words should be completely random. Random means nobody should be able to predict what those words will be. Researchers reported that some older cold card firmware dating back to 2021 may not have fully used the hardware's random number generator while creating those recovery phrases. That could make some recovery phrases more predictable than users expected. In certain situations, someone with enough information could potentially reproduce those recovery phrases without ever connecting to the wallet itself. Researchers also noted that simply updating the firmware today may not change a recovery phrase that was originally created using the older firmware. That doesn't mean every cold card wallet is affected. It also doesn't mean people should panic. The bigger lesson is this: good security starts with understanding the tools you're using. The more you understand how your wallet works, the better prepared you'll be to protect your investments. Awareness is one of the strongest forms of risk management. Brad of Bitcoin, let's wrap everything up.
Mahalo, Market Hui. This week reminded us that markets don't move because of just one headline. They move because many different pieces of the puzzle come together at the same time. We learned what the Federal Reserve does. We learned why interest rates matter. We learned what earnings reports tell us about a company. We learned that GDP is like America's economic report card. We learned that Treasury yields are the interest the U.S. government pays when it borrows money. And we learned that good security begins with understanding the tools you're using. At first, the financial news can sound like a completely different language. Words like inflation, GDP, Treasury yields, and market sentiment can feel confusing. But every week you learn another piece of the puzzle. Before long, those words won't sound confusing anymore. They'll start making sense. That's how financial literacy is built. One lesson, one headline, 1 week at a time. If this episode helped make the markets easier to understand, be sure to like, share, save, and follow Market Mana. And if there's a financial word or headline you'd like us to explain in a future episode, let us know in the comments. Remember, this is education, not financial advice. You be akamai now, or Bombay, you learn later. Aloha.